What's up guys, today we're going to be talking about common mistakes for newer investors in the market. My name is Kevin Murray and this channel is all about personal finance tips and long-term investing. What are the common mistakes for all newer investors? My first mistake I ever made in the stock market was having a plan or strategy. One of the most sustainable strategy in the market is just buying and holding a quote-unquote long-term investor. It's not one of the most exciting things to do in the market. You're not going to lose money if you stick with it. In option trading, you're only caring about the stock price day to day or even weekly. You don't care about the underlying business model. You only care how much it goes up or down in a matter of time. That's how you make money. Respect to them, but it's not sustainable for the average person. Back in 2019, I started investing on Robinhood, the platform. I took very different approaches when investing. I did some day trading. I did some option trading. I joined different groups that called out plays for different option contracts. They were telling me step by step, okay, invest in this specific stock at this specific strike price at this specific date and time. I was just blindly following them and just investing what they're investing in. My win to loss ratio was 30%. I was losing more than I'm making. Why would I stick with it? I stuck with it for 2 to 3 months and I lost money. I lost about 2 months of my pay at my part-time job. So if you kind of add it up, 20 hours times 12, 4 weeks in a month, yeah, I lost my wages or my hard working money. And I found out, I remembered day trading, option trading, I don't think that's meant for me. There must be a more sustainable strategy. I remember Warren Buffett is the greatest investor of all time. What is his investing strategy in the market? It's value investing. What is value investing? He takes a long-term approach in investing. And there's a quote by Buffett. Nobody wants to get rich in the stock market and a long-term or over time. He says this question. You know why? Because everyone cares about short-term fluctuations. Everyone wants that quick money. But that's not how the market works. Buffett started with like a couple hundred when he was like 11 or 12. And now he's a multi-billionaire in his 90s and still investing. And how did he invest so successfully? He created wealth over time, which is called compounding. You won't see the effects of it when you're younger, like myself, just first starting out. Compounding takes effect. The more you have it, the more it's going to grow. It's like a snowball going down the hill. It's going to get bigger over time. Where you're going to see the effects like later in life. You'll be a multi-millionaire or multi-billionaire if you want that. Money is never going to buy you happiness, that old saying. But you have to define, be specific, like what you want out of this lifetime. What is this money going to be used for? Is it for generational wealth? Are you going to donate your whole portfolio like Warren Buffett? Are you going to use that money for vacation experiences, going to the nicest hotels, food, and all that stuff? Define your rich life. Like I'm learning that concept from I Will Teach You to Be Rich. It's one of my favorite personal finance books by Ramit Sethi. And let's just jump back with Warren Buffett. What types of investments does he make? Some examples of his investments is what? Bank of America, Coca-Cola, Kraft Heinz, General Motors. He's in some energy, healthcare, and training companies. He's not really into the flashy growth stocks like electric vehicles like Tesla, Lucid, or Neo. Is a Chinese electric vehicle maker, or Palantir, like a data AI company, software company. He's not into the hype like what these retail investors are like, including me. I'm in a couple growth stocks. Warren Buffett, he's more into blue chip companies that aren't as risky. They pay dividends. With his time frame in the stock market, he doesn't have a lot, quote unquote. But when you're older, investing of dividends, you're just owning this company because they pay a specific amount. Dividends are you buy a share of this company and they pay you for holding it essentially. For every share, you might get $2 worth or 2% of that stock price. Like it's a cool thing if you add it up and like compounding work for you. The pros of dividend investing is you get capital appreciation. When your stocks go up, you get the dividends, the cash flows. But the negatives are these businesses are not reinvesting their revenues into new products or services or expanding. They're putting most of their revenues back to the investors. Warren Buffett just buys and holds forever. He doesn't care about the short-term fluctuations. He stays disciplined and patient. Billions of dollars at Berkshire Hathaway, his investing firm he owns, and he didn't buy during the crash. He hasn't bought really anything like in the last like 2 or 3 years. He invested like in Verizon or General Motors. His last quarter, he sold out a Barrick Gold. Like he does like small transaction, but I don't think that's him that's running anymore. His partners are like the new generation. It's coming after Buffett. That's really taking on Berkshire Hathaway. I'm going on a tangent, but that's where it goes. First found out Warren Buffett, I started watching all his YouTube videos, like his old Berkshire Hathaway shareholder meetings with Charlie Munger. Learned like their wisdom over time. Like people ask them questions, they get interviewed by these CNBC, Yahoo Finance, and like key takeaways that I could apply in my real life. Their wisdom of 70, 80 plus years in the market. I get it right now as a college student. And my experience in the market is around like 2 years, and it's just the beginning. Like after like reading Warren Buffett letters, learning different books of investing, like a very famous like stock market book is called One Up on Wall Street by Peter Lynch. Who Peter Lynch is a very well-known fund manager between the 70s and 90s. He had a compounding annual return of like around like 29%, which is crazy. Back then, the market right now returns to 6 to 8% each and every single year, which is the S&P 500. Most people invest in the index, and most financial advisors tell you to go that route. Investing in VU or SPY or VTI, ticker symbols, you get an easy 6 to 8% return, and just think long term. Peter Lynch got an overall return of 29% 100%. He's doubling his money like every few years instead of like 8 to 9. Retail investors have the edge of most mutual funds and hedge fund managers on Wall Street. They're the ones, the consumers are going out and testing products and services they like. They're seeing like what's selling or not. Wall Street's on their big computer making spreadsheet models and projecting revenue numbers. They're not on the field, going to different stores, checking trends on online. They don't have time for that, quote unquote. But retail investors can. That's like the main key takeaway. It's what's called common sense investing. Invest in companies you own like Apple, Facebook, Amazon. I know those are the big tech companies, but Netflix or Google. Or invest in companies that are going to be growing in their fields like Upwork, one of the leaders in the freelancing space. Of course, they're leader in gaming and streaming, just content creation. And I started like reading more books like Rich Dad Poor Dad. It's a very famous personal finance book by Robert Kiyosaki. I Will Teach You to Be Rich, which I talked about today, another personal finance book. The Intelligent Investor. It's a 1,000-page stock market book that teaches you about value investing, like how Warren Buffett thinks and how he goes through a stock using different metrics. Technical if you're into that stuff. I like reading books in general. As a beginner in the stock market, it's just about experience and just consuming and just taking action and just experience the market firsthand. Can you take the short-term fluctuations of the market? And you can't predict the market in the short term, but in the long term you can. Can you handle that? Where you get like an ache in your stomach? Can you handle that rationally and unemotionally? It's all about psychology in the market. I keep repeating throughout my video. It's all psychology in the market. Don't listen to someone that says this is going to be the next 10x stock on YouTube or TikTok, because they're probably in it just for the views and just pumping that stock up in the short term. You gotta show your bullish thesis. Does the fundamentals and valuation make sense in the short term? Is this stock priced in for the next 2 to 3 years? Does it look like a good deal 4 to 5, 6 years down the line? That's why value investing is really important. And how does Warren Buffett understand these companies on a high level? He reads the 10K, which I'll talk about later in my videos, 10Qs. There are hundreds of pages of financial statements. It tells you the business model, the risk factors, numbers of how this company is doing. A publicly traded company has to do this to show investors like how they're doing as a company. And like with this type of investing, you can make hundreds of percents instead of like conservative return in the market. It takes a lot of work and discipline. Have a plan. Long-term investing is the way to go. I'm not selling this. It's facts. You don't want to play that short-term fluctuation. You don't want to be attached to the short-term prices. You're in it for the long-term buying and holding. And really just forgetting about it, I'm just filing it in the cabinet. That kind of analogy. But you have to check on the companies you're investing in. I check every company I'm investing in my portfolio and go on Google and just check on the latest news and see, are there any updates, new products or services? Is it positively or negatively? Are they getting portrayed positively or negatively? What do these financial analysis are telling the public? Is it a buy or sell? I mean, I don't listen to that. That's your own opinion. I just follow my opinion. Most of investing is psychology. It takes hours to do research. The amount of time I do it. The amount of 10Ks I read. It takes hours. You could read the 10K, but then you have to read the 10Q. Then you gotta understand like their total addressable market. There's different factors, but I'll be talking about that later. But thank you for watching and peace out.